going on, ladies and gentlemen? Give people a minute to join in here real quick and let me know. Make sure you guys can hear me okay. Hanging out today at the Rockwall Clubhouse Golf Course. I want to make sure I got a good connection before I start here, actually. So I am not seeing a whole lot of confirmation here from YouTube in terms of my internet connection quality. Hey, Flower. Thanks for joining me. What's going on, Javi? You guys hear me okay? You guys have any trouble? What's going on, Big Ace, Michael, Sebas, Lace Jung, welcome. Cheers. Thanks, my friends. We're looking at some serious issues with these banks. People really are extremely unaware as to what's going on because everything looks good as far as the Fed's concerned. Cheers, Zachary, Jamie, Scott. Appreciate you guys. I wish this was my yard. It's practically my backyard, though. It's right down the block from the house. So I'm blessed to be able to come out here and spend some time at the pool, go to the clubhouse, hit some balls. It's always a good time. Who doesn't like hitting balls? Keenan, that's right. Our friend AMC Bigums is a father again. So congratulations to you, my friend, and your family, AMC Bigums. I will not use his real name, of course, but cheers to him and his family. The real TNT, my friend Lit Exchange, can't wait to work with you either, that's for sure. Welcome, Robert. Thanks everybody for joining us. I'm going to talk about the bank term funding program, the reverse repo operations, and the lack of liquidity in financial markets right now. Let's just say it's getting sucked out by the Federal Reserve's vacuum really quickly. Before I do, I'm just going to take a minute. So we're literally right now looking at a Lehman Brothers repeat. The majority of Americans are completely unaware. So the BTFP is draining extremely fast, and it's sucking the liquidity out of the financial sector because banks are repaying their BTFP loans. What this means, because the Federal Reserve stopped issuing new bank term federal program loans on March 11th of this year, we call it BTFP loans, all banks have to repay those loans within 12 months of the inception date of the loan. So for a significant period of time, up until March 11th, banks were able to take out these loans. We're talking $100 billion plus in loans, almost $200 billion worth, and the majority of them were made before March. So the value of the bonds, well, let's put it this way, that the BTFP allows banks to borrow against their bonds at the original par value, even when they've seen massive unrealized losses, okay? And the value of these bonds has dropped significantly, but because they were loaned out for par value, this artificially cooks the books for these banks. And it makes their balance sheets appear stronger than they actually are, okay? Now what this means is the same thing that it meant for Lehman Brothers, because this is exactly what they did. Lehman Brothers did this, and they obscured over $50 billion in unrealized losses until it was too late. The Federal Reserve values these securities at par value, their original value, allowing banks to borrow more than if the securities were valued at actual current market prices. So this helps the banks avoid selling securities at an incredible loss, which would hurt their balance sheets and their initial margin collateral, right? And this artificially prevents margin calls. So by borrowing at this par value, the banks maintain their liquidity without realizing losses on their securities portfolios. However, this doesn't change the fact that these securities have incredible amounts of losses, unrealized losses for now. And this is only temporarily supporting bank liquidity and stability. Thanks, Eric. Good to hear. Glad you guys can hear me okay. Welcome to Lake Ray Hubbard in beautiful Rockwall, Texas. So when these banks had these 10-year bonds, they were purchased at 1% interest rates during the ZIRP policy, time of the Federal Reserve, zero interest rate policy, ZIRP. And when rates hit 5% last year, they lost around 50% of their total value. Now, the Fed gave them 100 pennies on the dollar, gave them 100 cents on the dollar on these BTFP loans, making it as if these losses that are currently unrealized but will eventually have to be realized never happened. So even though bonds have lost incredible amounts over the last 18 months to these increasing interest rates, banks used high quality securities like United States Treasuries as collateral for these loans from the Federal Reserve at the BTFP. And similarly, today, they're still able to use par value of their treasury bonds and stuff in the RRP, the reverse repo program. And these are basically overnight bond loans. Cody says, I've been warning people about this, but nobody takes it seriously. That's absolutely right, my friend. Absolutely right. So what we're looking at right now is the RRP from these money market funds today came in at $367 billion in overnight loans, 367. This is a massive contrast to the highs that the RRP was at 12 months ago. It was over $2.5 trillion. What more needs to be said about that? It goes from $2.5 trillion to $357 billion today. 367, excuse me. Arigato from Rowlett, Texas. Cheers, my friend. I was just over there over the weekend, enjoying some time in the downtown Rowlett area as well with the fam. So basically, all this excess cash that has been used by the United States Treasury to soak up their issuances of Treasury bonds. And this is an indirect form of yield curve control. So what this means is that the once massively inverted 2-year over 10-year yield curve has become less inverted due to the use of the money market funds excess cash parked in the RRP. Again, this was done by United States Treasury Secretary Janet Yellen to buy the bonds. And the yield curve inversion means the difference of the 2-year UST bond and the 10-year, basically, in case you didn't know. And usually it makes perfect sense that the 10-year bond would be worth more. But when the 2 years worth more than the 10-year bond, this is what's called an inverted yield. And that only occurs during or prior to recessions and stock and bond market corrections. Think about it. Would you lock your money into a bank CD at a higher rate for 2 years opposed to 10? Of course. This almost never happens unless there's actually a recession or a recession on the way. But of course, there'd be no reason to lock in all of your money or whatever portion of your money for less than a 10-year, for less returns than you would get over a 10-year period. It doesn't make any sense at all. Tyler, listening from the mountains of Colorado. Cheers, my friends. We're worldwide over here. Black Widow hanging out only 16 miles from me right now. That's good to see. And basically the only reason that this occurs is because economists and finance experts believe that our economy in the US will be stronger over the coming 2 years than it will be over the next 10. Or the following 8 after that, you should say. So this definitely makes the long-term outlook look bleak for a variety of reasons that we can discuss in a longer form video here. So all of the above allows major banks to look well capitalized, more so than they actually are. So their stability is greatly being manipulated here. The United States Treasury is issuing bonds when there's reduced demand, and it prevents banks from becoming margin called or having to fire sell assets to increase their cash position and maintain their margin. So you can see why they're doing all the above and why the Federal Reserve is helping these banks to do that as well. So this is all temporarily delaying unrealized losses in stocks, bonds, crypto, real estate, and other assets. So as the excess liquidity in the financial markets is drained, and then these losses will accelerate too. So eventually, they will realize losses as banks repay their Bank Term Funding Program loans, and they'll need to sell off other assets like stocks in order to maintain their initial margin and regulatory capital requirements on short positions in things like precious metals and other equities markets, which in my opinion is exactly what you're seeing now on Nvidia and some of these other companies. And I'll tell you exactly how bad the losses are on Nvidia. They're so bad, in short, that they exceed the entire market capitalization of Tesla by 150%. And I'm talking in a 10-day period. So the Fed is really between a rock and a hard place here, guys. Raising rates in September would reaccelerate inflation way too fast. It would increase home values, automobile values, the prices of oil, gas, and groceries, and further devalue the US dollar, causing them to have to raise rates again in the near future. Markets would absolutely melt up if the Fed were to raise here in September. Now, the opposite here would be leaving interest rates unchanged. And this would further increase unemployment, losses in commercial real estate, residential real estate, corporate bankruptcies, meltdowns in stocks, bonds, crypto, real estate, etc., and allow them to blame these losses on the election of Donald Trump as president of the United States. But this is what they need to do to prevent inflation from raging hotter. You're damned if you do, and you're damned if you don't, kind of situation. But the sad thing is here, you guys know this, the Fed is aligned with big banks, and they don't actually care what happens to the middle class. Expect them to do what benefits big banks and the Federal Reserve the most. Markets are pricing in an 83% chance of rate cuts this September. 83% chance. Should they cut? Honestly, all signs point to no. But it benefits the Federal Reserve and the banks, and of course people in Congress and senators, the top 0.1%, to have a September rate cut. So I'll let you think about that and think what they're going to do next. So seeing as it would benefit them to cut, do you really suspect they'll do this and then try to blame Donald Trump for increasing inflation next year? All signs point to yes. Yes, we are probably looking at September rate cuts here. I'm not saying it's what they should do. I'm saying it's what they're probably going to do. So remember that $50 billion in losses that I mentioned above for Lehman Brothers? Today's banks used $85 billion to borrow over $170 billion in fair asset value, basically par value, approximately 95% more than their actual value, and must be repaid. And that's coming very soon, without question. So they used, from 85 billion, they used $170 billion as leverage through the use of these toxic financial derivatives. This is Lehman Brothers on steroids, ladies and gentlemen, on steroids. Now, talking about the fire selling of assets, look at what's going on with Nvidia right now. They've erased $1 trillion of their market cap since their all-time highs set June 26th. So Nvidia erased $200 billion worth of market cap every single week over the last 5 weeks, and the stock is currently down 27% from their all-time highs. So in 5 weeks, Nvidia has erased as much market cap as 150% of the entire market cap of Tesla. This is the same value as the entire market capitalization of Berkshire Hathaway. In 5 weeks, ladies and gentlemen. If you ask me, that's the sound of the stock market bubble popping. This is something that this country cannot financially recover from. T-Wiz says it's still up from the beginning of the year, so yeah, correct. We got a long way to go, my friend. The beginning of a correction does not mean it's the end. Simply the start. You guys are looking at something that's poised to take years to play out. This is not going to be an overnight thing. This is not going to be an overnight market crash. You're going to see it melt down, melt up, melt down, melt up. And eventually, over the next several years, there will be a serious correction. T-Wiz says, I've been waiting for a crash since 2018. Well, that was much too early, my friend, because zero interest rate policy was roaring hot. They were printing trillions and trillions of dollars. And even now, they're printing these trillions of dollars, but they no longer have the ability to use zero interest rate policy to maintain the positions. That's not something that's possible anymore. Mr. Mista says, vote Kamala Harris if you're an idiot. Vote Kamala Harris if you want more of the same. If you want more illegal immigration and overinflated asset classes and sending hundreds of billions of dollars to Ukraine and Israel. Thanks, Pam, Lisa, Maynard, ladies and gentlemen. So I appreciate all you. I don't want this video to get too long. Let's keep it short. I'll do a long form video either tomorrow or the day after on the channel. I do it both on YouTube and on X. So on Twitter, you guys can catch me at BossBlunts1. Here, of course, on YouTube, you guys can catch me, the Butcher of Wall Street. C. Jonesy, good luck on your retirement. My friends, I wish you all peace and wealth. Make sure you're properly hedged. Cheers.